Hello, I'm Juliet Schooling-Latter, Research Director at Chelsea, and I'm here with Michael Clark, Manager of Fidelity Enhanced Income, one of the funds which features in our Global Income Easy ISA. So, Michael, could you tell us a bit about your investment process, please?
Yes, the main thing to say about our investment process is that we want to invest in companies where we understand the business thoroughly. We want businesses which generate a lot of cash, where we can be confident in making a forecast 3 to 5 years into the future, and where we can see a business that's going to be bigger at the end of that 5-year period than it is today. So we want some growth over that period of time. We also want businesses which are in a good competitive position, which are not cyclical, and where we can have confidence in them generally.
You enhance the income on the fund using covered call options. I wonder if you could explain to our viewers exactly what a covered call option is, please.
Yes, we go to a part of the exchange where options are dealt. Options are what they say, they're options to buy shares rather than whole shares themselves, and they trade at a fraction of the price of the whole share. So what we do is we sell to other parties in the market options to buy the shares in the fund, and we generate a premium on that, which is counted towards the income. So it's a few pence. It's like a second dividend stream on each share in the fund, and that's how we enhance the income.
And would you expect the Enhanced Income Fund to perform in the same way as other UK equity income funds?
There is a certain cost to the enhancement strategy, which means that, especially in times of rising markets, the Enhanced Income Fund can lag other income funds which are not overwritten. And we've seen that in the past 6 to 7 months particularly. But investors' capital has been preserved, investors' capital has in fact grown in line with inflation, and we've generated the higher income. So there's a certain cost to the strategy, and that's what it is.
UK companies paid record dividends in 2012, and the markets rallied really quite strongly. I wondered what your thoughts were on the outlook for dividends and the market as a whole this year.
Well, I think dividends this year will rise about 7%, certainly a high single-digit number. Why is that when the economy isn't growing? Well, it's because a lot of the companies that pay dividends in the UK have extensive non-UK operations in parts of the world where there is some economic growth. For example, the US or the Far East. These are now very important areas for some of the major household names in the UK, like Unilever, for example. So we would expect dividend growth for that reason from those companies. Another reason might be the weakness of sterling, because those dividends, those foreign dividends, are generated obviously in foreign currencies, and with the currency translation effect into sterling, you'll get a kind of translation growth driver on the UK sterling dividend. So I'm pretty confident that we will see decent growth in dividends this year. And the market as a whole, I think, although we have seen a good rise in the market over the past 6 to 7 months, I think the market will still continue to go higher, maybe not at the same pace, because interest rates are likely to remain low, and there are some signs that the economy is recovering to a small extent.
And how is the fund currently positioned?
Well, we're still positioned more or less as we were 6 months ago. So we have big positions in pharmaceuticals, which we think are undervalued, generate a lot of cash, have a strong dividend profile. We also have a lot of consumer staple stocks, companies that like Unilever, like the tobaccos, like some of the supermarket companies, where dividends are very visible and are growing. Where we're underweight is still in the UK domestic banks, where we still see problems and some time before dividends are restored, and also in the mining and oil sector, where we feel prospects are less good.
Thank you, Michael.
Pleasure.